evening to all of you. Cat 3 is the most glamorous, the most public, and the sexiest category in AIF. Right or wrong? Okay? This is where all the mystery is, this is where all the noise is, this is where all the talk is. So what we want to do is we want to cut through the noise and the clutter, and we want to simplify things for our audience here. Okay, and given the fact that I have 4 fund managers and someone who understands investment products very well, in fact, very few people understand investment products as well as Ashwin. Let's begin by asking each one of you, except Ashwin, what kind of Cat 3 funds do you run and what is the broader strategy you follow? Don't need to describe the strategy in detail. It's a long shot, or that would be enough. So, yeah.
Hi, good evening everyone. So we run within Cat 3 we run 2 strategies. One is the long short, which I would say is the country's largest in terms of AUM. And
how big is it?
So we are currently at 2,500 crores.
Okay.
And the other one is the absolute return strategy.
Okay. Okay. And then absolute returns, is it a very quant-driven model?
No, it's a multi-asset strategy.
Okay.
And on the equity side, it is more fundamental based.
Okay. Dhaval.
Yeah. So we run largely Cat 3 AIFs. We run multiple Cat 3 AIFs across strategies. The advantage for AIF is that you can do a lot of combination. You can be a lot more innovative in terms of products. So we have also a product which is a combination of listed and unlisted. So roughly 70% will be listed, remaining 30% will be unlisted, which will largely be IPO. Again, a category 3 AIF. So that's the bouquet of products which we offer. Category 3 largely 100% listed, and as well as a combination of listed and unlisted.
Oh, great, interesting bouquet of products. And Rajesh, you've been running a long short fund for a very, very long time.
That is correct. So at ITI, we are very focused on only running one product, which is the ITI long short equity fund. So that's an equity oriented long short fund, and we are extremely focused on only one product.
So at ASK, amongst Cat 3 AIFs, we have 2 different teams. We have a hedge fund solutions business, which runs 2 strategies. One is long short and the other is an index plus strategy. The team that I am coming from, within Cat 3 AIFs, we run a pure long only listed equity fund.
Okay, and
Yeah.
your hedge, what do they do? How do they run?
So our hedge funds team, they have 2 different products. One is a long short fund and the other is an index plus fund, which has been recently launched. And they also run it within the Cat 3 category.
Okay, fantastic. Ashwin, given the fact that it's a very diverse category, how do you look at each product category, and how do you decide what products to recommend to what kind of clients? Long, short hand, long hand, hedging hand, or index plus, whatever these things.
So I think you have to look at it from a lens, 2 or 3 different lenses. One is what is the gating, or what is the area under which the fund manager is trying to operate. So a very simple one has just come out, for example, is that are you trying to do something which is long only, or are you also trying to take an additional exposure through shorting or derivative or something else? So that is in terms of what is it that you're trying to do. Second is by doing that, what is it that you're trying to achieve? Are you trying to achieve a risk management outcome? Are you trying to achieve a higher return outcome? Are you trying to achieve something which is more near term in nature? Are you trying to achieve something which is more longer term in nature? So that's the second part. And then the third part, which is that what are the credentials of being able to do that? Is this a strategy that, because Indian markets are in many ways unique because of the way our structure is, and what is the basis or confidence that you have that given the market circumstances, whatever A and B is, what is the strategy and what is the outcome, what is our level of confidence that those can be achieved, of course, given the manager's track record, given the market structure, etc. So if all of these things fall in place, then that is a great outcome, and hopefully that is a great outcome for both the manager as well as for the clients. There are many times when these things also take time to develop because we are at the end of the day a slightly nascent market when it comes to sophisticated alternate strategies. I think many of these strategies, for example, long short, etc., while some of the managers have a longer track record, but as a market, we are still coming to terms with how to best understand or how to best explain these to investors or their use cases to investors. So it's a journey.
Okay. I'll take a cue, Ajay, from what Ashwin was talking about. He's talking about outcomes. So what are the outcomes that you are looking at in your particular funds, and why do you believe that those outcomes are best arrived at through the strategy that you follow?
I think it's an interesting question, and I think that is what people need to understand. If you look at what we do in a long short, it is a significant long bias long short strategy. So why do I say that? Because if you look at, and this is something we do only on the large caps. So if you look at the large cap mutual fund category is somewhere close to 4.5 lakh crores. And broadly, I have seen that 3/4 of the AUM underperforms the benchmark on a post-fees basis, and that is mainly because if you look at it, they are benchmark-hugging portfolios and minimal risk management. On the other hand, on the Cat 3, especially what we end up doing, which is a long bias, long short, we try to address these two loopholes and with a much lower risk. So if you look at the mutual fund industry, they are generally invested almost 9,500 rupees at any point of time, whether it is a bullish market or a bearish market. Whereas if you look at a strategy like us, we are deployed on an average, say anywhere between 70 to 75%. And even with much lower deployment, we have ended up delivering anywhere between 300 to 500 bips of outperformance on a post-fees basis. So the outcome, what you are trying to understand is that by taking lower risk in the market, we have delivered 300 to 500 bips of outperformance, and that is the power of Cat 3 AIF and the access to derivatives, which you can actually optimize and get this outcome. So this is on the long short side. And then on the absolute return, as most of them would know, it is more of a debt plus kind of a product. And there, if you do a multi-asset strategy using Cat 3, these days, without taking duration risk or credit risk, you end up getting less than 5% on a post-fees, post-tax basis. Whereas these kind of products can deliver 1.5x, 1.7x those returns. So those are the kind of outcomes which you can get in these strategies on a long-term basis.
Okay. Dhaval, in your case, what are the outcomes that you're looking for in your major flagship product, and what is your and how does your strategy fit into that?
Sure. So at Motilal Oswal AMC, we focus a lot on process. See, eventually strategy is a subset. Eventually how you are investing, what is the process that will determine a higher alpha or a higher performance, which is key to investing. So our focus is very clear to focus on companies, to focus on sectors which are high quality, high growth. That is our DNA. So our focus is always on high quality, high growth investing. Now coming to outcome, see, given that it's an AIF, the minimum ticket size is 1 CR, you would want to build a differentiated product. You would want to build a product which is not easily available on an MF platform. So that's what our DNA has always been, that to be more differentiated, to be more, not to over diversify. So normally we build a 25-30 stock portfolio, I think, which is a right blend of maximizing returns and considering this also into the picture. And that's what our always focus and strategy is all about. Coming to returns, see, eventually your process has to be consistent, your process has to be thorough. Returns will always be an outcome in investing. And our endeavor till now, we have delivered strong returns. Our alpha, which is returns higher than benchmark. So eventually, over a 3 to 5 year time frame, if you see most of the benchmark in India, like BSE 500 or NSE 500 is a widely used benchmark, will give you somewhere around 13 to 15% kind of a CAGR return. Our endeavor is always to beat that by at least 6 to 8% on a consistent basis, net of fees and expenses, that's when individual will be satisfied. That's when he will come to a product like an AIF, and that's what our endeavor always is on the listed side. So I also mentioned we have a product which is a combination of listed and unlisted. Now, given that it has an unlisted flavor to it, historically we have seen the returns of that product is higher compared to 100% listed, and there are reasons behind it. Because unlisted, normally you don't mark to market on a daily basis. You have to mark to market once in 6 months. So especially during the downside, like we had in the month of Jan, Feb, March, where we saw a broader correction across the broader market, the share of unlisted will be protected because it doesn't get impacted on a mark-to-market basis. Second thing, see, companies are smart, so our focus is always on investing companies which is pre-IPO, like our time frame is that companies should come for listing in next 1.5 to 2 years time frame. So companies are smart, they will come only during, they'll come for IPO only during when the markets are good. So on the upside, you get the entire cream and your downside is protected. So for the combination of listed and unlisted, our endeavor is to deliver at least 2 to 3% higher alpha compared to purely listed, which again our endeavor is to be in the range of 6 to 8% compared to benchmark.
Rajesh, what is it that investors can expect? What is your implicit promise to your investors in your long short fund? And why do you claim that your strategy is the best suited for that?
Yeah, so basically at ITI we've been running, as you pointed out, Prem, a long short strategy for over 7 years. We have one of the longest track records in the long short equity business. See, typically India is a very conventional long only market. The long short business globally is $1.5 trillion. It's taking baby steps in India. So we are I think we are probably we have this journey of setting up a track record, sets the benchmark for what should people really expect from a long short equity fund. So our promise to the investor is we are investing in an alternate asset, which is an alternate to long only. Long only has a certain risk return profile. The risk return profile has to be very different in a long short product. Otherwise, why bother with an alternate platform? So our expectation is that asymmetric return profile. What I mean by that is we are an equity product, but we participate on the upside in equity, but we don't participate on the downside in equity. So we protect downside, in fact almost capital, in that journey. So fortunately in the last 7.5 years, I can just give you one example. During the COVID period when the market was down, top to bottom 38%, we were actually up. So that's the value add. It's a totally differentiated risk return profile that you would get in a long only product. And I personally believe the need for such a product has just gone up dramatically in India. And we are hearing that from many smart family offices. A lot of people at this moment believe Indian markets are very expensive, right? And that even if things go right, we will make probably a 11 or 12% return. And that's the best case. But look at the geopolitical challenges. I just met an auto ancillary company which exports. They are extremely pessimistic on how the next 3 quarters are going to go for them. So a lot of geopolitical uncertainty is being brought in at a time when our valuations are high. So a lot of people, especially smart family offices, want a product where if things go right, I still make an equity return. But if things go wrong, then I want an allocation to a liquid strategy that can protect my capital. So that is really the value add that we bring into the table as a long short product.
Okay. Sandip, the same question to you. What is the outcome that you are targeting through your flagship Khatri fund, and why do you think your approach is the best?
Sure. Thanks, Prem. Actually, Khatri AIF is just a platform. Money is made through philosophy, through insights, rather than through information, knowledge, which these days is easily available, or through a platform. In our Khatri AIF also, we bring in place our philosophy of investing in leadership businesses, wherein the management quality is top-notch where the balance sheet is sound. So that is the product, or that is the basket of companies that we invest in. In Cat 3, what we are able to do is, we are able to take concentrated bets. So the number of stocks that we own does not exceed 30, it is between 20 to 30. Also, because the ticket size is 1 crore and above, and we are able to explain to our clients that in equities, money is made through holding for the long term, we are actually able to do justice to the product and invest for the long term. So the churn ratios in general would be relatively lower. Also, we would be very different from the benchmark. There are many products out there which would be very close to the benchmark, but we would be very different. So let's say from one of our products, we actually do not have any investments in BFSI or any investments in the IT sector, and these are really large components of the benchmark per se. So the Cat 3 AIF, because of the clientele, we are able to really do justice to equities as an asset class. So this is for the long only Cat 3 AIFs, the business which I belong to. But we also have a separate business which does long short, wherein the idea is to give fixed income plus kind of returns. And they also have a product called Index Plus, wherein the idea is to give returns over and above Nifty by using a combination of long and short strategies.
Ashwin, we heard these four investment gurus talk about their approach. I wanted to ask you one very simple thing. You look at all investment products, right? You are doing this for one of the largest wealth managers in the country. You're looking at a very broad spectrum of products. So do you think Cat 3, because of certain advantages, is able to deliver what mutual funds can't?
So the short answer is there is nothing inherent in Cat 3 which gives you an advantage.
Okay.
And I think there has been a platform that is...
But given the fact that, sorry to butt in, but some of the things that they can do in Cat 3, they cannot do in a mix of listed, unlisted, Rajesh said, long, short.
So yes, let me adjust what I said, which is that if you are offering a long only strategy, there is nothing inherently in the Cat 3 platform that gives you any kind of differentiation or advantage just because of the vehicle.
Okay.
Right? We've also, I think in the past, been guilty of abusing this platform for just showing something differentiated which practically has not been, and that's also affected journey. I think things are settling down. I think it's probably a growing pains for this sector, you could say, but things are settling down, I think, in the last 2-3 years. What you've seen is, if you have to broadly, let's say, differentiate between vanilla long-only strategies and all the other strategies, whether they could be absolute return, long, short, any other approaches, then I think in the long only, I think things are settling down. Finally, you don't have the Me Too strategies and genuinely people trying to offer something on AIFs which is clearly differentiated. And I think the performance numbers are stacking up for the better managers. For the other strategies, long, short, etc., I think we are still in the early days, I would say. My personal thing is that I believe there is a value addition that the good managers are adding, but the numbers are still very, very, the performance track record is still not long enough. We've still not seen enough cycles. We still don't understand the method behind the madness. And it's still a lot of it, trust me, I know, approach of fund managers more than any kind of systematic approach around process, etc., which comes to the fore. So it makes it very, very difficult for both wealth managers as well as end clients to actually take, because numbers are history. What you're allocating to is what will happen going forward. And the reality is that the predictability of outcomes is actually quite poor right now. So that is where we are all sort of still waiting to see how these things pan out. And the third thing I'll say is that Cat 3 also, I think we have not talked about it that much, but it gives you scope for example, things like leverage, which I think some of us will use, and using derivatives and some of the other approaches. And I think it is quite exciting if you can do some of those things there to create differentiation or create different product ideas, and we have started to see some of that play out also. So to summarize what I said, long only, some of the good managers starting to deliver returns, long short, still early days, tough to see the predictability of that performance, but very interesting space which I watch the space more is, things where you can use leverage and some of the derivative approaches in a smart way.
Yeah. So, all of you have been running Cat 3 funds for quite some time, each one of you. So, during choppy markets, what is your approach to managing drawdowns? And what has been your experience? Is there a rush from the clients to draw down? What does it do?
Yeah, so I think that is where the whole flexibility of Cat 3 comes into play. During choppy markets, I would say there are two parts to it. One is the whole hedging part, and secondly, obviously, the simplest thing to do is reduce the exposure. The point is that when you believe that the returns from a particular level is not going to be that significant, and the intent, as Rajesh also mentioned, that the intent is on the way down, you have to give that kind of protection. So you either reduce the exposure and bring it down to whatever levels, or you feel that the hedging is the best tool. You can end up doing that through the derivative. And at the end of the day, I have seen that everyone is seeking alpha, and since morning, couple of sessions what we have done, everyone is seeking alpha, right? My point is that in a rising market, depending on the construct of the portfolio, you will end up delivering superior returns. But I think the trick of the trade is if you end up protecting those returns in a falling market, that can amplify your alpha over a longer period of time in a very significant way. So my sense is that the whole Cat 3 flexibility which it gives, and the access to derivatives and the deployment of, I would say, option strategies and lot many other things is generating a lot of alpha over a longer period of time, whether be it through protecting the downside or maybe making money out of it. So in choppy markets, I think there are a lot of things which you can end up doing and add alpha to the portfolio.
Okay. But have you had a situation where you had to really manage drawdowns, and has that impacted the way you...
See, basically it's an equity product, right? So at the end of the day, if you see markets going down, you cannot completely escape the drawdown. So we all have gone through those cycles of witnessing drawdowns, right? But the point is that, as I said, the flexibility of Cat 3, you can end up being really agile and ensure that the drawdowns are restricted, and then on the way up, you can also participate in that up cycle.
Yes, sir.
So, see, eventually, at the end of the day, long only Cat 3 products is just a vehicle. Whether drawdowns happen in a Cat 3 product or in a PMS product or even a mutual fund product, there will always be a lot of queries from clients, because no client will ever like a capital loss. So again, coming back to the philosophy, eventually drawdowns you have to stick to your core of investing, because as I mentioned that category 3 AIF is just a vehicle. What you have bought in category 3 AIF is utmost important. That comes to the core of investing. So that core of investing has to be very clear, and the advantage of category 3 AIF, like most of the products of category 3 AIF are close-ended in nature. And the lifespan on an average is around 5 to 7 years. Now 5 to 7 years is a reasonably good amount of lifespan for any product to outperform the market on an average by 6 to 8%. So as I told you, 5-year time frame, most of the time the market will give you around 13 to 15% kind of a CAGR, and you have to outperform the same. The second advantage of a close-ended product is that the mindset of the client is very clear when they are giving up the check. That the life of the product is for 5 years. So they are very clear that they don't require that particular amount for 5 years, which is very important in investing, because if you start timing the market, eventually your returns will get impacted. The advantage of a close-ended category 3 AIF is that the client is there with you for the entire 5 years. Most of the clients will be there with you for the entire 5 years. So you will see the ups, you will see the downs, but at the end of the day, you will see a sizable alpha.
Okay. So, Rajesh, you alluded to the fact that you were able to protect the downside. In fact, you said that in a falling market, you were able to deliver positive returns. But did you see a rush from the clients to draw down?
Yeah, so I think, while we've been running the long short equity product for 7.5 years, and we have a very, very consistent track record of protecting downside. Every time there has been a greater than a 10% fall in the market, we've been able to protect downside. And by the way, this is if you extend it as fund managers, we have an 18-year history. So why haven't people really leaped to such a product where you can protect capital and make equity return? The answer is the last 5 years have been so good for equity long-only managers that a lot of people believe, that downside protection doesn't matter. Eventually, markets come back. So unless a year like 2008 takes place, right, where you lose 55%, and for 7 years you don't make an equity return, right? 100 rupees that you gave to a long-only manager in Jan 2008, he gave you 100 rupees back, nominal value, in 2015. And for 10 years, you did not make even fixed income returns. Only then will the realization dawn that I need alternate assets, right? This has happened in 1996 to 2003. So for 7 years or 8 years, if you do not make equity returns, so if you're advising a 50-year-old, 60-year-old, and telling him you only need equity because equities always come back, and for 10 years he doesn't make money, right? That is the time that people will realize you have a more certain chance of making an equity return with a long short product. Because when that massive downside takes place, your long short has protected capital. And as soon as that upside takes place, he's going to make an equity return. So that is, I think we have unfortunately not gone through that phase of a very large decline. And I think there's some complacency that equities always come back and will give you an equity return. So I don't really need capital protection. So I think that's the challenge that we face. But I think if we keep building history, India is not used to a long short platform. So if we keep building history, people will know what to expect. And people will know if you're able to do it across cycles and across 20 years of your track record, your long short industry will blossom in India. So I'm fairly confident that there's a value that the product offers, but it's also situational and it cannot be preempted unless we go through that down cycle. People will not realize that I need an asset allocation, which is a liquid strategy, which is different from a long.
Sandip.
So, as far as our long-only Cat3 AIFs are concerned, during choppy markets, it is part of the journey. I think the clientele, given that they are high net worth individuals, UHNIs, who've cut a big check, and we've sold the product saying that it's a long-term product, they do appreciate the fact that markets are going to be choppy at times, and hence they are able to ride through that choppiness. So, we've not really seen exits due to choppiness in the markets in our Cat3 products per se. Also, as far as investing is concerned, we generally do invest in relatively strong businesses with a leadership kind of a character. So the clientele, the distributor partners are also relatively aware that good businesses will ultimately come back, and this is part of the journey. As far as our other hedge fund solutions business is concerned, they actually benefit from a falling market as well because they are able to short, and then they, on the long side, they have ranges, and they would generally move towards the lower end of the range in terms of their exposure to equities at that point of time. So overall, I think it is more about how the product is sold, to whom it is sold, and if it is explained properly, I think like any other long-only equity platform, clients are fine to ride through the choppiness in Cat3 AIFs as well.
Okay, great. Given where the Indian markets are today, How are you positioning your portfolios over the next 12 to 18 months? And which segments, which sectors do you see the best opportunities?
Yeah, so I think if you go back maybe say 5 years, you'll see that the Nifty earnings CAGR from almost FY21 till FY24 was north of 20%, and which is a significantly higher growth at the headline level, right? And then therefore we saw a sharp rally in the markets as well. Now, because of multiple factors, which includes global uncertainty, domestic slowdown, and so on and so forth, we have seen FY25 growth rate falling from almost 20% to 5-6%, right? So obviously, for a 5-6% growth, the markets are trading at somewhere around 20 times forward, which doesn't look that exciting for very large institutional FI investors, and therefore we are not seeing that kind of inflows as well. And I think that going forward also, the way it looks like right now, although a lot of measures have been taken by RBI and the government recently regarding the GST and all, I think unless we move back to that 13-14% kind of a growth, which I think will take few quarters, I think markets are likely to stay in this range only. And the way we build portfolio and construct it, we always look for sectors and stocks which can grow at 1.5 to 2x that of the benchmark earnings growth. So then in that case, we are looking at sectors like a cement or an auto or in a couple of other sectors which we believe that can deliver a far superior growth versus the benchmark. And then we give away the sectors which are delivering subpar growth. So that is how we build the portfolio.
Dhaval, given where the Indian markets are today, how are you positioning your portfolios over the next 12 to 18 months? And where do you see opportunities? Which segments, which sectors, which industries offer the best opportunities?
Sure. So, see, eventually, be it Indian market or be it any market of the world, underlying earnings growth is utmost important. So when we say that say PE of Nifty right now is 20x, historically it used to be around 18-19x. If your PE is same, then over the years the returns which you have made is nothing but the earnings growth of Nifty 50. So underlying earning growth plays a very critical role. Like S&P 500 is a classic example. S&P 500, despite so much of uncertainty in US out there, is hitting lifetime high. Or last week only it was at lifetime high because their earnings growth has been very, very strong. So S&P 500 being a developed market, last quarter earning growth was around 12%. It's not a small number for a market like US. Now coming to what we see, how the future is going to look like. So we had a very strong run from FY21 to FY24, largely because earnings was really strong. Earnings for Nifty 50 was 22% CAGR. Last 5 quarters, from Q1 of FY25 to the last quarter, most probably even this quarter, you have seen earnings decelerate from 20% plus CAGR to as low as 5-6%. And eventually we have seen markets largely sideways. If you see last 1 year return of Nifty is flattish to marginal negative. That has played a role. Earnings have played a critical role. Our sense is Q3 FY26 onwards, you will start seeing uptake in earnings. And there are multiple levers because of that. So you should also understand why earnings decelerated. Our sense is because of 2 things. Your government capex was low and the liquidity in the system was really low a year back. Both these issues are getting addressed. Your government capex have started to increase, and as we speak, the new governor is very much pro-growth, and we have seen that the liquidity in the system is quite surplus. Both will start getting into the earnings trajectory. The advantage with GST rate cut, if it does happen, most probably it will happen, you will start seeing a consumption boom, which was lacking for almost last 2 years or so, where your rural was doing okay, but urban demand was very, very slow. A GST rate cut will further fillip that. And on the export front, right now there is uncertainty with US, but I am quite confident you will find a solution in a quarter or 2. Not only that, Europe can be another big leg for export because we have already signed an FTA with UK, and quite likely you will see an FTA being signed with Europe also in next few quarters. So, coming back to the summary, where we strongly believe that market earnings have bottomed out. 5-6% earnings growth will not accelerate from here on. You will start seeing in higher earnings growth from Q3 onwards. That's where the next phase of up move in market will start. And consolidation is always good in equity market. So we had a very strong bull run from 2021 to 2024. Last 1 year was a year of consolidation, which is important for the next phase of bull run. Now coming to sectors. So we as a house, we focus a lot on themes, because in markets, if you get the themes right, more than 80% of your work is done. So let's assume that we were having this discussion in the time frame of year 1997. Now if you see in the year 1997, Nifty 50 constituents, it was largely dominated by asset heavy companies. Even companies like sugar, paper were part of Nifty 50. At that time, IT was an industry which was new, which was growing and had a strong longevity, visibility of growth. So any manager who would have identified that theme early, the returns would have been up substantially higher compared to any competition. So that's what our focus has always been on, identifying themes. So we have identified 7 broader themes which we as a house are quite bullish on, and at least 65% of our portfolios are part of these themes. So just to name a few, like electronic manufacturing services, one such theme which we as a house are quite bullish on. Now if you see this industry, EMS as we say as a short form, this industry was not even born 10 years back.
Dhaval, just name this thing and let's
Sure. So yeah, so like EMS is an industry which we as a house are quite bullish on. Renewable energy is an industry which we as a house are quite bullish on. Consumer tech again is a space which we as a house are quite bullish on.
Great. So Rajesh, how are you positioning your portfolio over the next 12 to 18 months?
I think Ajay and I will have a bad reputation that long short managers tend to be pessimistic and are always scaring you of the risk that is to come. That is absolutely not true, right? We tend to be, long short managers have to be very, very balanced in their approach as to how they see things. They are not optimistic, they are not pessimistic, they are actually realistic. And probably that's the best thought process to have when you're investing for the long term. Okay, so let me kind of dissect it the way we see it from the optimistic side and the pessimistic side. See, the optimistic side, as my colleague pointed out, there are so many businesses. I've been an analyst for 30 plus years. There are just so many businesses in India which they have a visibility of growth for the next 5 or 10 years. Electronic manufacturing services, CDMO, right, defense, life insurance, general insurance, you take any sector. Everything is so underpenetrated that everything looks as if it's going to grow for the next 5 or 10 years. And that keeps us very excited about the potential for returns in the Indian markets. Now let me look at the pessimistic side. And I think Ajay alluded to this as well. The margins and the profit growth since COVID period has been fantastic. Margins have gone from 9% to 12%. Profit to GDP has gone from 2 to 3% to 5 to 6%. That's one of the highest levels that we've seen probably in the last 25 years. So we're at the peak of the margin and peak of profit to GDP. So what do you require to grow earnings? You require GDP growth rate. Unfortunately, if you look at the constituents of GDP, C plus I plus G plus X minus M, you don't get a very positive feeling that there's something that can move GDP in an aggressive manner from the 6.5 to 7% that we have. Which means, as Ajay pointed out, this year has been very anemic for earnings growth. It's been single digits. So we need to accelerate earnings in a very significant way, for which you require very good GDP acceleration. So on the pessimistic side, given at 22 times earnings, do we have the potential to grow earnings in an attractive way? So on balance, we feel there are many businesses, digital commerce, electronic and defense, so many businesses that look attractive, but on the negative side, I think there are some of these challenges that we face that we have to navigate.
Yes, Sandip, how are you positioning your portfolio?
So we are actually quite bullish on growth from the second half of the year onwards. We believe that there is a strong, on the domestic side, there is a strong regulatory push to growth, there is a monetary push to growth, and now there is a fiscal push to growth as well. As soon as, Q2 is not going to be that great in terms of earnings, but as soon as some of the macro news flow starts to get better, especially on the global side, with perhaps resolution of the geopolitical issues or a trade deal with the US, etc., we think that the sentiments on the markets are also going to improve. So while earnings will come with a lag, I think markets would start to price in a recovery before that. So we could actually be surprised in terms of what the markets are going to do. As far as our positioning on sectors is concerned, we are really bullish on the entire manufacturing space. We believe that this is a multi-year global cycle, multi-decade global cycle that is playing out, wherein there is a shift of manufacturing towards India. This happens every few decades. And if we are not with this shift, then we are essentially against this shift. So we would want to be with this shift. Along with this global cycle, there is an Indian cycle of reforms that is playing out, where we are perhaps seeing for the first time 10 to 15 years of continuous economic reforms in the country. So for us, manufacturing is a multi-decadal strong theme. Along with that, we are bullish on infrastructure. We are very bullish on energy. Within energy, the entire power value chain is something which we like, because as the economy moves from being agriculture intensive to manufacturing intensive, the power requirements go up. And then defense is another sector, because all countries across the globe would now unfortunately would need to up their defense investments. And in India, this cycle, which started a few years ago, in our view is going to continue for a really long time.
So, Ashwin, I wanted to ask you one question. What distinguishes you? I'm sure you do a lot of analysis of the performance of different categories, because I'm sure a lot of manufacturers want to work with you, already work with you. And so, what distinguishes top category fund manager from the rest of the pack?
I think conviction, clearly demarcated thought process. What is less appreciated is also a little bit of skin in the game. So we have seen a lot of very high quality managers set up their own boutiques, and we really like that approach because that shows complete alignment. One of the challenges we always have is when you back a certain manager and his thought process, but you don't know if that person is going to remain in that firm beyond the next 12 months, 18 months. So how do you allocate capital in that situation? When you have these boutiques which are owner managers, when you run by owner managers, that really helps align the skin in the game and the interest of investors and managers. So what we've seen is, if you have clear conviction, you have a high quality manager with a strong track record, and there is skin in the game and alignment of interest and reasonable fees, because let's not forget, if you're allocating for the long term and the fees are unreasonable, then over time that just takes away a lot of that alpha. So if those things are in place, then you typically have seen like I said earlier, our experience has been quite good. We have seen that the good quality managers have delivered very, very handily in the last few years, even in the long only space.
Okay, so one final question to all of you, which is, what is the one piece of advice do you give to the audience here, the largely wealth managers and distributors, in selecting a category fund for their clients? How should they do it?
So I think it may sound as cliche as it may, but I think it's high time where we start evaluating performance based on risk-reward ratio. People just compare performance on a headline basis, but if the overall risk taken for a particular strategy is lower and still the manager has delivered much better or even similar performance, I think the product differentiation is in front of you rather than just looking at the headline numbers. So I would strongly urge wealth managers to start educating and maybe start creating that kind of awareness, because now we have so many different strategies in market. It is the risk-reward ratio which matters the most.
Okay. Ashwin, what would be your advice to this group of wealth managers and distributors?
I think at the end of the day, this is a very, very, still is by and large not a quant or a system process. It is a personal process, person-specific process. So you have to back the right person. And like I said earlier, unfortunately, a lot of times we see that person changing midway, right? So basically you'll have to figure out where is it that you have stability of teams, stability of managers, you have a manager that has a longer term history, and you know, if those things are in place, chances are that you will get a reasonable outcome over a period of time.
Okay, Dhaval, the same question to you. If you were to give one piece of advice to the wealth managers here in selecting a Cat 3 fund, what would it be?
So wealth managers are smart individuals actually. They know far better what is the key strata when selecting a fund. But my single point would be that, see, performance is always an outcome in investing, and performance can vary. The focus should be on process, like how you are getting the performance, the process of your house, the process of your fund, and whether you are true to the label. Because we have seen over the years, like people deviate from what their core strength is, or deviate from the structure of the fund. You should not do that. So you should be true to the label, and the focus should always be on the process. Eventually, if you do both of this, I always feel performance will follow. Performance is always an outcome.
Great. Rajesh, what would be the one piece of advice you would give to the wealth managers and distributors here selecting a Cat 3?
If they're looking at long short funds, my recommendation would be don't jump into a long short product with 1 year history. Please evaluate those long short strategies after seeing a full cycle. That's one. So I think a good long term track record does matter to know whether the process works and it can be delivered in up markets and down markets. So that's really one. Second, I think yes, as much as we try to institutionalize the investing business, I think it's a little bit about the temperament of the person who's running the strategy, even more so in a long short strategy. So the quality of the talent that, see, just because there is an institution which is a very large institution, we probably are hiring a very middle level manager to run a long short strategy, right? It's because there's just one more product for that very large institution. Whereas for some other firms, and which are only doing long short, they may be probably putting their best resource to the long short strategy. So I think it's not the institution that matters, it is the capability of the person who's running this. That is also kind of going to be equally important, especially in a product like a long short product. Of course, we try to institutionalize as much as possible, but investing is individualistic and even more so in the long short strategy.
Yeah, Sandip.
Yeah, so I think the most important thing is the philosophy, which is underlying the investments that the fund manager is making, and the alignment that you have or the client has with that philosophy. Along with it, whether that philosophy is actually getting reflected in the portfolio that is being made. So there should not be a difference with the philosophy that is getting propagated and the portfolio that is made. So if you align with the philosophy and the portfolio, I think that is the most important in selecting a fund manager.
I'd just like to conclude with one thing. Please take an international fund manager, except Warren Buffett and Peter Lynch, in this Indian audience. Name that fund manager and I'll tell you he's a long short manager. Scott Bessent, who's the Treasury Secretary, is a long short manager. George Soros, Bill Ackman, Jim Rogers. Please take Sir Klarman. Any name that you think of. Globally, especially in America, the best talent goes to managing long short funds. So just something that for you to ponder, because that is really where talent is required.
Okay. So thank you, gentlemen. We talked about a very complex, a very diverse, and a very competitive market situation. Thank you for explaining the nuances of what Cat 3 is. And you've done a wonderful job, and you've kept it very simple, you've kept it very direct. Thank you to all of you.